Two mics here. All right, well, thanks very much for having us. This paper is joint with Tom Krebs, who's drinking coffee over there, and Moritz, who's in Bonn drinking beer. And it's about limited enforcement and its effects on human capital. All right, so specifically, we know there are a number of institutional features of most advanced economies, such as bankruptcy codes, that limit the pledgeability of future labour income and satisfaction of debts. Now, I think it's pretty well known and widely accepted that this has an effect in constraining the kind of investments people can undertake in human capital, where we interpret that broadly as not just education, but also on-the-job training and potentially also investments in people's health. It's also well known theoretically that these kind of lack of pledgeability could have implications more broadly for consumption, insurance, and in particular insurance against a bunch of human capital risks, where here again we're thinking of health, death, disability, but also labour market risk. So we know that's true in theory, but what's far from clear is whether or not it's relevant in practice. And the literature up until very recently has kind of concluded that it's not. I'm thinking here of papers by Cordoba and Kruger and Perry, who find that in a calibrated model, macro model of this phenomenon, you get almost perfect insurance. So you're very far from the data in terms of being able to explain the underinsurance we observe. Now, earlier this year, Tom, Moritz, and I published a paper that found something very different, but with a similar framework. Now, that paper was mostly focused on the life insurance choices of the young and the middle-aged. But we found much more generally that in a life cycle model with physical and risky human capital accumulation, a macro model calibrated to the same kind of things, that you get far less insurance against a whole bunch of risks that impact a person's consumption. And so the point of the paper today is to kind of drill down into that and ask, well, why are we getting results that are so very different from what people have had before? And to argue that it's a very natural set of changes to those models, and that therefore these remain a very promising set of tools for research into these questions. And specifically what we do is we actually present first a more generalized version of the paper, the model in the paper that I mentioned. But then for the purposes of this talk, I'm then going to illustrate what's going on using a much simpler model that tries to focus on what are the key forces. And our basic findings are twofold. Right? The challenge here is to reconcile the fact that there's very imperfect consumption insurance with the fact that there's a lot of aggregate savings. The capital stock is 3 times income. There's a lot of assets out there, and although we know it's fairly unequally held, large chunks of the population have some assets. So the question is, why is it that they have assets but are still relatively poorly insured? And our argument is you really need 2 things. First, you need some reason for these people to borrow. Right? In the standard models, the only reason to borrow was to tilt your consumption a little bit and to smooth out temporary fluctuations in your income. If you add something like a strong life cycle profile that is a reason for the young to borrow, or you have high human capital investments that you can, high return human capital investments that you can undertake, that serves to drive people onto their borrowing constraints. And when they're on their borrowing constraints, they choose not to purchase that much insurance, and you get the underinsurance result. At the same time, you need a very rich asset structure, which allows agents to be simultaneously borrowing constrained, against at least borrowing against some states of nature, while at the same time still being net savers. So what we're arguing is you need a model that can handle the fact that gross positions of households are much larger and very different in qualitative features from their net asset positions. Now, we'll show you that the limited enforcement model is a very tractable way of generating this kind of framework, and I'll argue that the particular way we implement it is especially tractable, and therefore I think of interest. Obviously, we stand on the shoulders of giants. This slide is to point out that we did cite Lance and a few other people. All right, so let me give you the model. This is a little bit more general than what we had in our other paper, although I'm going to pretty quickly specialize it to something a little bit simpler. All right, so all the actions on the household side. There's a continuum of households, and they're maximizing the expected discounted value of the utility which they derive from consumption. So here, beta is going to be the discount factor. U is a felicity function over consumption. We're going to assume it's isoelastic, constant relative risk aversion. In the earlier paper, we worked entirely with log preferences, but we show how to generalize everything to a broader isoelastic class here. It's a lot of uncertainty. That's going to be indexed by states of nature. There's some initial state S0, and we're taking expectations over all the possible histories that could eventuate after S0. It'll come up a little bit later. pi t is going to be the probability pi of S superscript t is the probability of a history S superscript t, and it's going to be generated by some Markov process encoded in pi. That's their objective. They're going to face a bunch of constraints. First is the flow budget constraint, which essentially says that your total consumption of the household at time t, plus your investments in human capital, xh at time t, plus your purchases of an entire range of state contingent securities that pay off in every possible state of the world tomorrow, st plus 1, and that sell at a discount encoded in qt that depends on the particular state we're talking about, can be no larger than your income, which is your income from renting your human capital out, r tilde, depends on the state of nature, times your total amount of human capital, plus any assets you had that paid off in today's state. Right, so the first thing to note is we're denominating investment in terms of units of consumption. This is, of course, equivalent to assuming that investment in human capital is produced using physical and human capital in exactly the same proportions that we use them to produce output. And it's designed to capture the idea of learning by doing, learning on the job. If you want to learn to make a better automobile, you have to make automobiles. The human capital accumulation equation then just says that your human capital next period is equal to your investment times some factor that is essentially the relative price of human capital in terms of the consumption good. Your human capital times 1 plus some epsilon shock. Now, this epsilon shock is going to contain a bunch of things like potential depreciation of your human capital, as well as, in principle, other time trends and things that might matter. And I'll explain that a little bit more as we go along. So in addition to those constraints, they're going to face a bunch of non-negativity constraints. They come in with some initial conditions. Lance.
So is the fact that there's no curvature on investment important?
Yeah, it's going to be very important for generating some of the tractability results that we have. It's going to bias a lot in that way. Now, like I said, there is this is formally equivalent to a model in which you have both human and physical capital used to produce the investment good. So you could have curvature in human capital in there, but definitely no curvature in the aggregate there. All right, so this is a paper about limited pledgeability. So the remaining constraints, and there's one of these for every date, every history, are these enforcement constraints. And what they say is that at any point in time t after any history s superscript t, the discounted expected value of your utility going forward has to be at least as large as what you would get by reneging on all your contracts. That's summarized in some value function Vd, where d is for default. And it depends on the amount of human capital you come into the period with as well as today's state. All right, where were we? Vd is the value of reneging on all your contracts. And we're designing this system so that you never actually do that. Right, so what is Vd? Well, in this particular paper, we're going to make assumptions that are kind of similar to our stylized version of the bankruptcy code. We're going to say all your assets are seized. So if you come into the period with any assets, they are going to be taken away from you. You're going to be excluded from financial markets for an average of some amount of periods indexed by some probability of remaining out of financial markets P. But you're going to retain the ability to work and supply your human capital. Right? So you keep your human capital, you can't have that seized from you. Now, we can actually accommodate a much broader range of assumptions. We can have proportional garnishment of your wages. We can allow for some financial access when you're in default. Turns out in the calibrated version of the model, these don't matter all that much for reasons that I'll explain as we go along. But these are going to be our baseline assumptions. And that's households. The rest of the economy is relatively standard. There is going to be a representative firm that hires physical capital, that's denoted by KT, and aggregate human capital HT. It produces using a constant returns to scale production function that just says that the rental rate on capital and the rental rate on human capital are both functions of the capital labor ratio K tilde. Aggregate capital accumulation is entirely standard. Capital tomorrow is 1 minus delta, that should be a little k on that to distinguish it from depreciation of human capital, times the capital you came into the period with, plus whatever investments you make in physical capital. Equilibrium is defined in a pretty standard way. The key points I want you to take away from it is that it's going to it's going to require that those arrow securities that people are trading are going to have to be priced in a risk-neutral manner, which means the price is going to depend on the probability of a particular state tomorrow. So it's the price of an asset that pays off in ST+1 depends on the probability of ST+1 occurring, discounted by the risk-free rate, which we're denoting by RF. And in equilibrium, it's going to have to be true that the risk-free rate is equal to the return on physical capital, which we're assuming is riskless, which is the rental rate of capital less the depreciation rate delta K. Market clearing simply says that if we sum up across all households' holdings of these financial assets, that must add up to the capital stock. And that's the model. It's a little bit more general than what we've done in the previous paper. And what we can show, and what makes this especially tractable, is that because of that linearity assumption, all of the policy functions in this model turn out to be linear in wealth. That's nice. It means they're all continuous, well-behaved, and that's not guaranteed in general in models like this because the value function is concave, and if you remember back, this is a constraint that says, whoops, you're greater than this concave value function. So in principle, this is a non-convex constraint. And so in general, we can't guarantee that our policy functions are going to be continuous at all. It turns out here, though, that they are, and we can prove that. And that's all because of the isoelasticity assumptions on utility and the linearity that's embedded in the technologies. Now, the nice thing about that is we can then take out wealth of an agent and just work in their portfolios, and that allows us to reduce the aggregate state space a little, which helps us to solve the model. And indeed, we can deal with a large amount of heterogeneity across households. In the paper that we had before, we had, I think, 40-something different ages. We had different family types denoted by the number of children and so on and so forth. I'm not going to have all of that here today, but we can handle that kind of, that kind of heterogeneity, which makes this, I think, an attractive framework. So that's the basic model. What I want to do now is put some numbers on it to give you a sense of why we were able to get different results than what the literature did before. And so what I'm going to do is two things. First, I'm going to describe a simplified version of the model where there's just three demographic types, if you like. I'm going to calibrate it and show how much risk sharing we get in that model. You're going to see that there's not a lot. The model produces a lot of underinsurance. And then I'm going to do some partial equilibrium comparative static exercises, varying parameters of the model, to show you what the key forces are, to give you a sense of what's really important. All right, so the calibration and the simplified version is going to be an annual calibration. The discount factor is going to be 0.95. We're going to use log utility in the benchmark, but we'll play with some other values for the coefficient of relative risk aversion as we go along. I'm going to focus on three age groups. All right, the first is the young. They're going to be aged from 20 to 40. I lobbied hard to raise that to 45 so I could still be called young, but 40 it is. 41 to 60 we're going to call middle-aged. So if you're 59, you're middle-aged in this world. 61 to 80 we'll call old. So when we go to the data, we'll be looking at data on those age groups. In the model, there's just going to be those three types. Now, it's going to be a stochastic overlapping generations model, if you like. You're young, and the probability that you're young next period is going to be the same as if you're middle-aged, the probability that you're still middle-aged next period, old next period. And that's going to be, there's a 1 in 20 chance that you're going to depart from that state. So on average, you're going to spend 20 years in each of these states. But obviously, some will spend more, some will spend less. We'll allow old households to transition to be young. We'll think of that as the grandparents die and the grandchildren replace them. Obviously, if they care about them, this is equivalent to an infinitely lived agent. The enforcement parameter is going to be set so that the household is out of markets if they default for 7 years. That's motivated by the bankruptcy code. We'll play with that a little bit, although I'm going to relegate that to the paper, not discuss it so much here, because it turns out not to matter very much. So that's the simplified kind of version. To complete the rest of the details of the calibration, the really key things are the returns on human capital investment and the returns on physical capital. So let me tell you about those. We're going to set the risk-free rate to be 3% in the equilibrium of this model. That's a pretty standard kind of number. Now, earlier I had this epsilon term that was multiplying the stock of human capital, affecting how much of it you had next period. This state, ST, is the state of the household. We're going to split the state up into two components. S1, which is going to be a kind of a demographic term. It's going to capture whether you're young, middle-aged, or old. And S2, which is going to capture a bunch of other idiosyncratic uncertainty. It could be disability risk, it could be labour market risk, for example. Then we're going to split that term up into three components. There's going to be a depreciation term. Some of your human capital is going to evaporate every period as you get forgetful. There's going to be a term that depends on your demographic type. We're going to think of that as kind of learning by doing. When you're young or middle-aged, you're accumulating skills faster than you are when you're old, for example. And then this eta term, which is the idiosyncratic component, that's going to capture everything else, labour market risk in particular. We'll assume that's mean zero, so that the expected return to human capital is going to be, when you substitute this back into the equations and manipulate, it's the rental rate on human capital, plus whatever learning by doing associated with your household type is going on, less any depreciation of human capital. And the key thing is how we're going to set these returns. So we're going to choose those to match a couple of simple empirical earnings growth measures. So for our young households, aged between 20 and 40, we're looking at, we're taking data from the Survey of Consumer Finance, deflating it, taking out some cohort and year effects, and computing that for the average household between 20 and 40, that's a hugely heterogeneous set of people. But for the average one, they grow, their earnings grow about 4% a year. In order to hit that in our calibration, we're going to need a return to human capital investment by the young of just under 10%. This isn't too bad a number. There's a lot of estimates of the returns to education that are much bigger than this. The evidence we have on returns to on-the-job training are kind of in this ballpark too, although we don't have that much evidence on it. For the middle-aged, 40 to 60, we see that earnings growth is actually negative. Your earnings are peaking 40, 45 and declining thereafter by a little less than 1% a year. So when we calibrate, the return to human capital investment for the middle age is going to be 4.65%. Less than the discount rate of 5%. That's why earnings growth is negative. We'll impose that the return for the old to investing in human capital is zero. That'll mean they won't want to hold any human capital. And we have to choose just how risky this epsilon shock is. We're going to calibrate that to 0.15. There's a range of estimates of this in the literature constructed with different techniques. 0.15 is a little bit at the lower end, but certainly in the ballpark of what people find. A couple of other details which are important for the general equilibrium, capital share standard. Aggregate capital output close to 3. This is where you get all of those assets, and this is why other models have had so much trouble producing limited insurance. With this much assets, you need to have some way for households to hold those assets while at the same time still be constrained. And that's where other papers have struggled. That implies a depreciation rate on physical capital of a little under 8%, and so on. All right, so I'm going to focus on three aspects.
So what's the stochastic process on the rental rates and so on? I mean, you gave us the means, but I'm just curious about what the dynamics are.
Yeah, it's really simple. So this is actually just going to be a constant that depends on the type, young, middle-aged, or old. That's a constant, and this is just an IID shock. We've calibrated to, I think, a log normal, approximated a log normal on a discrete state space, so that standard deviation is 0.15. That's it.
Log income for the surrender.
Yeah.
This IID, but then income is actually surrender, so persistent in terms of earnings, but not human capital.
Yeah, so
That might be important.
yeah, the linearity ensures that these IID shocks are persistent in their effects. All right, so I'm going to focus on three aspects of the equilibrium to kind of illustrate what's going on. The first will be the human capital choice. We'll denote that by theta H. That's the share of your portfolio of your wealth that's in human capital. That's a hard thing to get your head around, so I'll show you a bunch of different ways of thinking about that. We're going to look at consumption insurance, CI, which will vary according to your household type. And we'll compute that as 1 minus the ratio of the standard deviation of your consumption growth in the model to what it would be if you had no access to financial markets but had the same human capital investment. And then we'll also ask a welfare question, delta, which will depend on your demographic type, which essentially says what's the equivalent variation of moving to full insurance holding your human capital investments fixed? How much would you need to be given to get the same utility as if you had full insurance, but were not able to vary your human capital choice? Obviously, if you had full insurance, you'd change your human capital choice. It's a risky asset. We're going to be holding that fixed. And here's what you get in our simple three-type model. By construction, the old hold no human capital. That's by assumption. They're fully insured. They would pay nothing to move to full insurance. So the interesting thing is the young and the middle-aged. And for the young, they had almost all of their wealth in human capital, about 98% of their wealth. I'll talk about that in a second. It drops to about 90% for the middle-aged. And here's the important thing. Consumption insurance, only about 40% of the risk in consumption is insured for the young. This number in the standard model is getting up well over 95%. It's down to 40% here. As for the middle-aged, about 25% of their consumption volatility is being insured, 75%. Sorry, 25% is uninsured. What does that mean for welfare? Well, the young would pay 3.5% of their lifetime consumption in perpetuity in order to access full, complete insurance markets, unconstrained by this pledgeability constraint. This is a big number. If you're familiar with the cost of business cycles, we're typically talking in numbers of 0.5%. There's been an entire literature trying to get it bigger than that. We're getting much bigger numbers for the young. For the middle age is about 1.5, also large by the standards of that literature. So these two things, a significant amount of underinsurance. Now you might be looking at that and saying 98% of your wealth in human capital, is that reasonable or not? Here's one way to think about it is to go to the data and to think, just manipulating the model, the ratio of financial wealth, net worth, in the model to your labor earnings is just the ratio, is just determined by your human capital share and the return to human capital. So we have this degree of freedom here that allows us to match whatever wealth earnings ratio we want at one point in the distribution. But as the theta H changes with demographic type, we can't match everything. And so this gives us a sense of to what extent we can kind of, how consistent we are with the data on that. If you go to the SCF and you compute total net worth, you see that relative to earnings, you see that for the young it's about 60%. For the middle age it's about 250% for the medians. I should say the medians. And for the old, it's about 7.3. If you exclude housing, that ratio drops to about 0.4 for the young, 1.2 for the middle-aged, 3.5 for the old. What the model produces is kind of right between those. It's on the low end, closer to the excluding housing for the young. On the little bit higher end, a bit closer to the middle-aged, for the total numbers for the middle-aged. And of course, because our old hold no human capital, they have no earnings, this ratio would be infinite for them. But I want to make the argument that this, the 0.98 kind of number is very much consistent with what you get out of this aspect of the data. So, lots of underinsurance. Why? So this is, I guess, the meat of what we want to talk about. We want to kind of communicate to you what it is about this model that gets such different results. And there are four kind of candidates on the table. The first is the way we've modeled the incentive to smooth your consumption and invest, the way we've modeled your incentives to borrow, which are essentially parameterized in our excess returns to human capital. So I'll be varying those in a partial equilibrium way to show you how much they matter. Note that that has two effects in our model. First, obviously it changes the direct return to investing in human capital, and that gives you a big incentive to borrow. But it also is going to affect, in principle, the amount of consumption, the amount of a life cycle profile in your earnings, and the desire of the young to borrow to smooth out their consumption over the life cycle. So there's two forces that are, in principle, are going to be changing when we change that excess return. We'll also play around with risk aversion, see how that matters. We'll talk about income risk, and in the paper we talk about enforcement. Turns out it really doesn't matter all that much for the kind of results we're talking about, at least within plausible ranges. And the reason, once you think about it, is pretty obvious. Our young have a very, very, very intense desire to borrow. They're not too far away, they're not too risk averse. And so if they lose access to financial markets, they just don't care that much about the details of that lost access. Right? Lose it for 7 years, lose it for 10 years, able to save, not able to save while you're in default. They don't matter that much because they don't want to save, they want to borrow very, very intensely. And they don't really care about the insurance because they're not that risk averse. So you can play with those things as much, over a wide range, and it really doesn't have much of an impact on the results. All the action's going to be in the other three. All right, so to do this, we'll have a partial equilibrium model in which the types are permanent. So there's no transitioning from young to middle-aged to old here. It's just there's permanent differences in the rate of return. And again, we'll focus on those three measures of economic outcomes. So here's the benchmark model. So the same calibration I've given you before. The only thing I'm changing is the human capital excess return. And I'm plotting here the portfolio choice. Right? So if you remember, the return to human capital investment of the young in the changing types model was just under 10%. It was a 3% risk-free rate. So they had an excess return of around 7% here. They had 98% of their wealth in human capital. These guys have slightly less than that here, but it's a slightly different model. The middle-aged had a return to human capital about 4.5%. Less 3% risk-free rate means they had a 1.5% excess return. They were having about 91% of their wealth in human capital. These guys have a little bit more than that. Again, it's a slightly different model. The key thing I want you to note is, if we're thinking about 0 to 10% as kind of plausible ranges for the human capital excess return, we can drive very big differences in portfolio holdings, particularly as returns get low. This point doesn't exactly correspond to 0. With a 0 excess return, you hold no human capital, but this is for a small positive number, and it's essentially capturing the fact that this goes very, very steeply to 0 in this neighborhood. So it matters because it shows that there's a very, very strong desire to borrow. In fact, if the returns get high enough, you actually short all your financial assets and borrow more than your wealth, borrow more to invest more than your wealth in human capital. So it's very sensitive to that. It's a very important driver of of what's going on in our model because it's driving the desire to borrow on average. Here's the corresponding plot of consumption insurance. Right? So once again, around 0.7 for the young, about 40% of their consumption risk is being insured. For the middle-aged, about 1.5% return, getting up around 75% being insured. And so very quickly it drops from complete insurance, if you have a 0 excess return and you're not invested in human capital, all the way down to under 20% when returns get up to about 16%. So this return difference is what drives big declines in the amount of insurance you get. Same kind of plot, but now it's the welfare gain holding fixed the portfolio share. Once again, if you have no human capital, you don't gain from better insurance, so there's no gain there at all. The young were gaining, we had 3% or so in the other model, but that was a model which you only spent 20 years on average young. Here you're going to spend longer, you're going to always be young. They get a return up around 5.5. Middle-aged kind of level, 1.5%. They gain about 1% or so in terms of welfare. So very significant numbers, especially when you think that the cost of business cycles would give you a number down here. You can get much bigger numbers out of this kind of mechanism. And that's really, I guess, the key thing. You need something, some reason for these guys to borrow, to drive them onto their borrowing constraints in order for them to be uninsured. The standard models have nothing like this. They don't have any investments in human capital, they're endowment models. They don't have any life cycle pattern to earnings. They've purged that when they calibrate. So they have no reason to be on their borrowing constraints. That's why they end up with lots of insurance. Now we can also experiment with varying a number of other parameters of the model. One thing, we've been working with log preferences so far. One thing you could do is raise the degree of risk aversion up to 2. It's a pretty modest change. It has a significant effect on portfolios. Not surprisingly, if you're more risk averse, you hold less of the risky asset. In this case, for kind of something around about the young, they go from holding over 95% of their wealth to around 90% if you just raise it by 1 point up to a coefficient of relative risk aversion of 2. Similarly, for the middle age, they go from a little under 90% to a little under 85%. So it's a pretty significant change. So this will matter too. What effect does that have on the degree of consumption insurance? Well, because you're not investing nearly so much in the risky asset, you end up much better insured all the way through the distribution. So whereas at 16% on the benchmark, less than 20%, only about 15% of your consumption risk was insured, now we're up closer to 40%. So what this says is that as you raise the, for a given human capital excess return, as you raise the degree of risk aversion, you're going to get a lot more insurance. Now, obviously, in a calibrated version of the model, in order to match the data, in order to get the portfolio shares right, we're going to have to combine a higher risk aversion with probably a higher excess return to get them to borrow enough. So this doesn't necessarily mean that the model with a risk aversion coefficient of 2 can't match the data. It's not a straight apples-to-apples comparison on these lines. What about welfare? Oh, sorry. Tom.
So you mentioned that the decision rules were linear?
That's correct, yeah.
So when you you're pushing people on borrowing constraints. So did you care to talk through that? Like there's some magic there.
Yeah, sorry.
So there's a Lagrange multiplier on that participation constraint that's going off sometime?
That's right,
But
yeah.
yet everything works out.
Yeah. The key thing is that everything is linear in wealth. Which is an aggregate of your investments in financial assets and your human capital. We can take wealth out and we're left with portfolio shares. The theta H I've been talking about, which I probably didn't define adequately, sorry for that, that's the share of your wealth that's in human capital. And the rest is going to be spread amongst those arrow securities, somewhere or another. So when we pull wealth out, our policy functions for portfolio shares are just numbers. They're not functions of wealth anymore. So some of those are...
Sorry. They're numbers that are functions of these parameters that you're varying right now.
Right, but not functions of wealth. Yeah, so that's where the linearity comes in. Now, some of those portfolio shares are going to be up against a constraint that says you can't lower your portfolio holding of this particular asset anymore. You can't make it more negative. You can't borrow more. That's where the Lagrange multipliers are going to go off. In some states of the world, they won't be up against their constraints. Those Lagrange multipliers will be 0. Does that get at what you're after? All right.
I see.
What about welfare? So I've just showed you they invest less in human capital, but they're more insured. For low levels of the excess return to human capital, there's not much difference between the two experiments there in terms of the welfare gains from moving to full insurance. As you get to higher excess returns, the welfare gains become more prominent. The differences become more prominent. They're smaller because they're much better insured on average.
So what's the elasticity of the human capital stock with respect to this gamma? Like how important is risk aversion affecting? This is partial equilibrium.
This is all partial equilibrium. You want to know the kind of general equilibrium, what this would mean? Or?
I mean, partial equilibrium, clearly. I'm just curious what magnitude you get.
Yeah, it's a good...
I don't know if you got it.
Yeah, so I mean, it's so this portfolio choice. It suggests, well, if we double the coefficient of relative risk aversion, we're losing about 6-7% in your portfolio share here. But I can't tell you whether that's constant as we continue to raise it further. But certainly in the neighborhood of 1, that seems to be about right. That's risk aversion. What about risk? earlier we calibrated the standard deviation of these idiosyncratic shocks to labour income to 0.15. Now we're just going to lower it to 0.1. What does that do? Well, not surprisingly, if you have less risk, you start off by wanting to invest more in the risky asset. And so at low human capital excess returns, you end up with more of your wealth in human capital. Of course, there's an offsetting effect, which is that the less risk there is, the less painful being excluded from insurance markets is, and everything else equal, the less insurance you'd have. And that begins to eat into that until at high rates of return, there's not much difference between the two portfolio shares. In terms of consumption insurance, you're getting less. Now at an excess return of around 16%, you're basically uninsured, almost entirely uninsured against consumption risk. As for welfare gains, they are, I think these are actually around the wrong way, Tom. Well, I mean, you've got much less consumption insurance now when you go to complete markets. There should be a bigger welfare gain, I think. So I think we might have these around the wrong way. And that's really all I had to say with a bit of time to spare. We've kind of posed the question, to a lot of people this has kind of been a bit of a dead-end area if you're trying to think about incomplete markets and imperfect consumption smoothing. These kind of limited enforcement models were kind of viewed as not being very successful, and work on them kind of stopped for a while. We kind of came back to it because A, we think it's very natural, and B, it's an extremely tractable way of introducing borrowing constraints that are tightly parameterized, but nonetheless are consistent with having a relatively rich set of financial assets, which allowed us to study things like life insurance markets. It turns out, though, in doing that, we found out the reason the other models weren't working was that they essentially were assuming away all of the main reasons you want to borrow. No high return to human capital, no life cycle path to earnings, no real reason to borrow, no real reason to be constrained. Everybody is fairly highly insured. But once you put those things back in, you can get significant underinsurance, and that's why we think these are a potentially fruitful class. At the same time, you can do all that while still having a lot of aggregate savings. And the key to that is not just that there are some people, the old, who hold a lot of assets, but also that our young people still hold, in net terms, a bunch of assets too. It's just that they're not unconstrained when they do so. In a standard incomplete markets model, if you have assets, you're not borrowing constrained. But here, with a relatively rich set of financial assets, you might be constrained borrowing against some states of the world in the future, while not being borrowing constrained against the average of them, so that you can have net savings but still be borrowing constrained. And so what we emphasize is that it's important to think about gross asset positions, not just net asset positions in this. Now, I've argued we can handle a lot more heterogeneity than I've shown you today. To give you a sense of things in the more general model, I'm just going to reproduce a couple of figures from that paper. The first is the
But that last slide,
Yeah.
when you say high levels of aggregate, these young, is this guys are just have a lot of human capital wealth? Or
Sorry. What I meant is there's a lot of physical capital out there.
So guys with positive physical capital aren't constrained, are
They are.
they are.
That's the key. So in the standard model, that would not, by which I mean an incomplete markets model with one asset, you would not be constrained unless you had a minimum savings requirement or something. Right?
But that's because of life cycle wage growth.
In this model.
Constraint, yeah.
That's what drives them under constraint. But the key is you're on the constraint while at the same time having positive net worth. And that's not something you see in a lot of models.
But when you say positive net worth, you're talking the sum of human and physical?
No, just financial.
Just financial?
Just financial. Yeah, just financial.
That's over your lifetime.
Everybody in this model, even the young, are holding some financial assets, positive in net terms, but they are nonetheless constrained in very, very many states. So these guys are,
Well, not only in the model, in the data as well.
In the
That's-
data as
That's
well,
our issue, right?
For the
When
median.
you go to the data, even
Yeah.
the young have some positive net worth. And this model can generate incomplete insurance even for those people. On the other hand, if you want to match the aggregate data, we still need some old people holding a lot of physical capital and non. So these are the two. We probably need heterogeneity plus this type of framework where you can be constrained even though you have positive net Sorry, but we just
No,
It's
absolutely.
Yes,
tricky,
you
'cause
need
sometimes
both.
when you talk about wealth, you're talking about the sum of human and
Yeah.
physical aspect, and sometimes it's confusing.
No, you're absolutely right.
That's just,
When we go to the data, we're always talking about financial wealth, net worth, not including human capital. But the object in the model I was referring to as wealth was both. You're absolutely right. Sorry about that. So just to give you a sense of what a richer version of the model can do, here's our measure of net worth to labour income. Again, the dots are from the Survey of Consumer Finance. Now we have one dot for every year from age 23 up to 60. And as you can see, even the 23-year-olds have a little bit of net worth relative to their labour income. This is the median, the ratio of medians. You know. Obviously, there are the bottom tail of the young don't have any, but the median does. The blue line is what our fully calibrated model produced. Now, it wasn't designed to hit this, but as you can see, it does a pretty good job up through age about 50 or so. Then we struggle a little bit more at the older ages. But we're pretty much in the ballpark there. For consumption insurance in that model, we found that the young, that age 23, were insured against only 25% of their consumption risk, but that the elderly were very highly insured. So in our model, at age 60, you transition to partially out of the workforce, but you still have some risk in your consumption and you're insured against more than 80% of it, but you're still a little bit underinsured. But again, at every age, you're less insured than you would be in the standard kind of model. And as for welfare costs, for the young, again, they're prepared to pay around 3% of their lifetime consumption, a 23-year-old, to get access to full insurance. The elderly, on the other hand, are not prepared to pay very much at all. So a richer version of the model produces similar kind of features, but is also able to match a bunch of extra factors. I'll stop there.
I just asked a question.
Absolutely.
You were talking about heterogeneity, but there's a lot of scope here for heterogeneity. So far, most of the heterogeneity is coming through these shocks. So if I were to play with something like the risk aversion, so you were sort of dismissing at the beginning, saying, well, I could get, I get some heterogeneity partly because of preference, maybe from initial endowments and so forth and so on. I'm just wondering the extent to which you experiment with kind of alternative representations. How much can you get off of saying, some people start with very low stocks of human capital, some very high, some are more risk averse than others. I just wondered what the literature says about that.
Yeah, we've experimented with starting with different levels of this wealth. It turns out not to matter so much because these policy...
So people get stochastic shocks about their endowments. Initial condition or even their human capital production function might have a different parameter like from the X.
Yeah. So we haven't fully explored that.
Yeah, I'm just wondering what the literature says.
Most of the literature has not incorporated human capital accumulation into these models. So there's no results with which we can compare here.
There's no paper in my home with limited enforcement in human capital.
Okay, no, I'm just asking.
No, we don't. That's
the answer.
That's the answer. So we are free to go whichever you.
No, I'm just curious how much you've experimented with different features with these models.
Along some dimensions, but not on a lot.
Yeah.
So adding different, we played with different heterogeneity and preferences, usually in the context of different households with different numbers of children having different marginal utilities of consumption.
Right.
But we haven't played so much with differences in risk aversion or differences in human
So
capital.
how far does that go? Just say that particular instance of a child, children, so there's a greater value of consumption.
It's potentially very powerful, so powerful that if you try and estimate what those parameters are, depending on what you're targeting with the estimates, they can vary very, very widely. So it's a very powerful mechanism for shaping their insurance choices.
Okay, so I'm Andy. I'm going to talk about this paper just very briefly. I think Mark did a good job of describing what they did. It was a pleasure to read, and I liked it a lot. I'm happy to talk about it. Okay, so this paper has this micro foundation for uninsurable human capital risk. It's playing on this Keogh-Levine, Thomas Werrall mechanism of limited pledgeability. Okay, so limited enforcement and non-pledgeable human capital means if I put in 10 units, if I buy 10 units of human capital, and Mark buys 10 units, he gets the shock that raises that up to 15. I get the shock that raises it down to 5. under complete markets, he would pay 5, I would receive 5. But now he has 15, he can go and live on an island and just consume out of that. He would maybe rather do that than to pay his what he's supposed to. So consumption can't be fully contingent on the good human capital shock, which in equilibrium means it also can't insure against the bad human capital shock. And so then they have this very clever, Mark talked about it a bit, but it's, I think, a real nice technical contribution on how to characterize these optimal contracts using those two assumptions of the CRA utility and the fact that the technology for accumulating human capital and the payments to human capital are linear. Okay? And they get this portfolio choice problem. And they find in the scheme of things this really big welfare loss from having the incomplete insurance due to the lack of the limited enforcement problem of 3.5%. That's what somebody would pay when they were young to be able to pledge their human capital. And then also, so let me just go on to the next thing. So my two comments are kind of on the one hand and then on the other hand. So when I read this paper, on the one hand, I think maybe that 3.5% is too small of a number because it doesn't reflect the effect on human capital investment when they calculate it. So when they calculate this welfare number, they hold the share, the portfolio share of human capital constant, and the linearity makes it where they really have to do that because if I let people adjust and they had full insurance, it would just go to infinity if the excess return was positive. Okay, so on the one hand, this buys tractability. On the other, I see that it constrains their ability to calculate this welfare gain. Okay, but on the other hand, and Mark talked about this a bit as well, I'm not quite sure everything has been put in correctly in the calibration. I might want to see some more robustness. On the other hand, this 3.5% might be too big because we have some policies and some legal institutions that might really limit the value of default. So specifically, in the US, student loans are not forgiven in formal bankruptcy. And while the stock of human capital is non-pledgeable, the flow can be confiscated through wage garnishments and tax offsets. And of course, you also lose access to future financial aid of all sorts. Okay, to try to make this comment about the investment margin and also to maybe clarify some of the mechanism for people who don't work with these kind of models, I try to do the simplest model I could think, a toy 3-period model. Okay, so here's the setup. You have consumption in period 1, 2, and 3, but you only care about 2 and 3. Okay, so period 1 is just going to be the situation where you're borrowing and investing in human capital. Okay, I'm going to use log. Everything's going to be deterministic here because I'm going to focus on how this limited enforcement affects the investment margin. Okay, so your amount of human capital is just in period 2 is just the investment in period 1, and the amount of human capital in period 3 is just the sum of the total investment. And then I'm going to follow this linear production, but I'm going to put an optimal finite scale into it by saying that you get proportional to your human capital up to some upper bound. This was sort of the simplest way, and I was trying to think of ways that maybe could be introduced into their rich model. Maybe they can say if they think this would be possible. There's some upper bound, okay? So it's exactly like their model, except there's no reason to ever go above cap H, and there's a positive excess return. W is bigger than 1, but the net interest rate is 0. There's no discounting. Okay. And then you borrow in period 1 to finance everything in period 2, and I'm going to put in the limited enforcement by saying in period 2 and only period 2, the household can default in the way that KKW had in their paper. Okay, so you can walk away in period 2. Doing so allows you to retain your human capital, but lose access to borrowing between period 2 and period 3. Period 3, you have to repay. Okay? So there's just this one little period there where there's this lack of enforcement. And so this is the way to think about how it affects this investment margin. Under commitment, everybody would just jump straight up to cap H in period 2 and keep it there in period 3. Okay? Without commitment, though, we have to think about the value of default. Repaying has a value that just says, well, I invest up to cap H in period 2. I repay how much I borrowed, which was how much I installed in period 1. I borrow some more, and then I repay my borrowing in period 3. Everybody has to do that. In default, though, you don't have to repay how much you borrowed in period 1. You get to walk away, but then you don't get to borrow. So your accumulation of human capital going into period 3 is just through direct investment out of your earnings. Okay? So what does this look like? So this is the constraint set on the amount of human capital that somebody can borrow to invest in period 1. The blue line is the value of default from period 2. Okay, so this is what you would get as a function of how much human capital you come into period 2 with if you were to walk away in default. The red line is what you get if you repay. Okay? The constraint, the enforcement constraint says we have to consider only levels of human capital to the left of that intersection. Okay? This is just strictly increasing up to that intersection, so the optimal value is just there. And this is the utility. If the household could commit, they would go up to cap H because I've built that into my technology, and this would be their utility. They would have 5 units of human capital rather than about 2. Okay? The welfare loss would be this vertical distance. I don't have it on here, but in consumption units, that's like 30% just with this little example. I don't know what it would be in a more realistic calibration. Okay? But you can see that this lack of enforcement, even without the insurance margin, still has an effect on equilibrium allocations. It limits the amount of human capital that can be accumulated through borrowing. Okay, so I only have 2 minutes. I'm gonna skip this. So because I want to bring up. I think if you had a model that allowed for this, and maybe Mark can say something whether he thinks that something like this would be possible so that they can have a finite optimal scale. I think you could ask some interesting questions about how other policies interact with this lack of enforcement. Essentially, lots of policies you can think of would shift up the value of repayment, leaving the value of default unchanged, which would allow some movement in that investment, okay, and an increase towards the full commitment value. Okay? But I don't know if they can do that. Comment 2 then, so that was on the one hand, maybe they have a lower bound on the welfare gain, because they're just looking at the welfare gain from increasing insurance. And this is the other hand, have they put in a realistic enough punishment in default? So in the US, I already said this, you get wage garnishment, tax refund offsets, although maybe that's not important here because the people who want to default wouldn't be getting tax refunds in their model anyway, I guess. But certainly there are these punishments that last kind of forever, and you don't get your student loans forgiven. Okay? And that would seem like maybe it could alleviate a lot of this friction, but I think it comes down to a question of calibration. Should all of the student loan debt be subject to this lack of commitment? Okay? And so essentially, this works the same way. Anything like a garnishment that you could introduce in the default value tends to keeps the repayment value unchanged. It pulls down the default value, which again allows for movement, increasing the amount of human capital. And I imagine it would do the same thing for the amount that could be insured. I think Mark showed us that a bit. Okay. So, in conclusion, 9 seconds. This was a very nice paper in the sense that I think it could even be pushed farther if some of the technical problems could be overcome with having a finite optimal scale of human capital. And it convinced me also that maybe some of the student loan policy that we actually have in the US is well designed. Because it seems like some of those policies are specifically built to help alleviate this problem. The only thing I thought is, have they done enough to push the actual legal institutions in the default state? capture this lack of the ability to expunge your student loan debt. Okay.
Just quickly. So thanks, Andy, for that. I don't really disagree with anything you're saying, but I just want to say two things. First is, yeah, the linearity assumption buys us a tremendous amount of tractability, but it obviously comes at a cost. We don't, we think this is a fine model to think about changing the penalty from bankruptcy by increasing the time you have a bankruptcy flag from 7 to 10 years. It's not a great model for thinking about reintroducing indentured servitude or big policy changes, because they do have these counterfactual implications. Now or maybe crazy. There are ways to deal with it, but they have their own costs as well. One would be just to brute force it and put it on the computer. At the moment, we can solve this model in seconds, estimated in a couple of hours. We wouldn't be able to do that if we added some of that extra richness, but that's the cost-benefit trade-off we have to make. The second is talking about student loans. Much of our research has been focused on households in their 20s, after they've already completed much of their formal education. So we weren't so much interested in student loan policies per se, we were much more interested in the kind of investments people undertake on the job after they've left school. And that's why we didn't include some of those details. Obviously, if you want to include schooling, then you would need to take them into account. And certainly that would introduce additional non-linearities that would add to the complexity of the problem. But for 23 plus, which is what we're focusing on, we don't think that's a big of a concern. But thanks.
You want to ask a question?
Question to Mark, or answer slightly differently. So, I mean, one point is that we can provide a richer analysis of the penalty of default. And so, for example, that's labor income is seized, and all these things we will do. And so we can do all these things. And this is an interesting question. So, and I wouldn't say necessarily they do not matter. They matter. Right? So I think our general result just that we can generate a lack of insurance in equilibrium for a significant group of households is quite robust to reasonable variations in these penalty parameters. Of course, if you go to a country where people are just punished very harshly, then our argument for lack of consumption insurance should go away in the limiting case. That must be true. And so we are not claiming it doesn't matter at all. Obviously, it should matter. And the second thing, just to reiterate, this is a paper about human capital, limited enforcement, and risk. I mean, there are lots of papers about limited enforcement, a few papers about limited enforcement in human capital, right? So, and borrowing constraints, but without risk. And so what we are adding here is risk. And there are lots of papers about limited enforcement and risk, but they didn't have this human capital channel and the heterogeneity. And this is important. So we are combining those two literatures, and our focus is on those three things and the implication for risk sharing. So this is quite. Mark said that a few times, but I want to emphasize this. And in that sense, of course, we are sort of just starting this research. There's a lot of stuff in other areas, right?
So is it feasible within the structure to do something that's more realistic, like shock processes?
Yes, yeah. Oh, yeah, a lot of things. So the only trick we use here in order to be able, not to what you've seen here, but to add more heterogeneity, which we want to do and also have done, and maybe aggregate shocks and also. The only trick we use here is some sort of linearity in the human capital accumulation process. By the way, we can also introduce time, cost, and goods cost and combine it. But then in the end, when you substitute it out, there must be some linearity there to a certain degree. That means this model wouldn't make sense if we didn't have risk, because these guys will always go to the corners. So we really focus on the trade-off between risk, sort of the risky net, and the borrowing constraint, without having curvature in the human capital production function. At the individual level, at the aggregate level, of course, we still have sort of the standard production function. And so in that sense, we might be missing something, but for the questions we are asking, especially the limited risk sharing question, we might not be hopefully missing so much, because to understand those trade-offs, you might not want to have the curvature in the capital production function. Also, the estimates, as I understand that, are not so far away from linearity, some of them. So, but again, there would be, I mean, everything we do, one could also do in a more complicated model with curvature, but then you would be limited in terms of heterogeneity. The simple models you can still solve, of course. But again, there is just that no literature on limited commitment, human capital, and risk share. This is just, and we started with this framework. because we thought it's the same.
I think we have time for one more
So,
question.
yeah, but now I'm taking.
So in the model, the way that bankruptcy hurts you, that you're just not allowed to participate in the capital market for a while. What if we change that to something that's a little more realistic, which is that you have a scarlet default that's attached to you? Isn't it the case in that model that no one would have an incentive to exclude you?
So so there's a big literature on to what extent do we think the exclusion is a credible punishment.
Yeah.
Would somebody have a reason? I've actually written several papers on that. And you can show that under some circumstances it is. Essentially, if somebody breaks this kind of agreement and lends to me, if other lenders can then undermine that lender, you can support that as an equilibrium. And so I've got some papers on that I can show you if you're interested. But it also depends to a degree on equilibrium concepts. You want to think about renegotiation proofness and things like that. So, but yes, it can be done. It just takes a little work.